Have you ever wondered how you're supposed to determine your specific portfolio mix as you go into retirement? What kinds of different stocks should I own? What kinds of different bonds should I own? What accounts should I own them in? It can very quickly become very confusing, but in today's video, I'm going to share with you an actual example of a prospect who came to us with about $3.2 million in their portfolio, completely confused as to how they should allocate it, and the steps we took to show them how. And by the way, whether or not you have that exact amount, it doesn't matter if you have 30 million, 3 million, or 300,000 in your portfolio, the principles that we go over today, the process we go over today is going to be the same regardless of your portfolio value. So stay tuned and let's jump right in to show you exactly how to determine this. I want to introduce you to Todd and Katie's sample. Now, of course, these names have changed, but this actual situation is very similar to the one that we went through with clients. Here's what happened. Todd and Katie came to us, and they had been really good and disciplined at saving, investing, keeping costs low, and then one day they realized that just growing a bigger portfolio does not automatically alleviate some of the financial concerns and some of the financial uncertainty that you have as you prepare for retirement. In fact, if anything, sometimes it magnifies it. Because as Todd and Katie came to us, they said, look, we feel comfortable with our portfolio. We think we've probably saved enough, but now we don't know what we don't know. We now realize the cost of mistake is going to be magnified because our portfolio is larger. They wanted to know, are we going to be okay? Can we spend more in retirement? And more than anything, they wanted to know they weren't leaving money on the table because of improper investment allocation or tax strategy or anything else. So we went through a full process with them, but what I want to focus on today is specifically how do we come up with the right investment mix for their retirement portfolio. So let's get to know Todd and Katie so you can see the foundations that some of this plan was built upon. You can see their various accounts here, whether it's joint accounts or 401ks, Roth IRAs, their home. You can see that their total net worth today is about $4.1 million, with about 3.2 to 3.3 of that in liquid portfolio assets. Now here's the ages of Todd and Katie. Todd is 66 and Katie is 63. If we look at their goals, what you can see is they wanted to retire today. One of the things holding them back though was, is our portfolio allocated the right way? How much can this allow for us to spend in retirement? What opportunities are we missing by not taking the right steps today to address some of these questions? So their goal was to retire today. They wanted to live on $8,500 per month in expenses throughout retirement, and expenses being core expenses, normal monthly expenses. On top of that though, we have to account for healthcare expenses. Based upon where they lived, based upon the coverage that they had, we estimated that pre-Medicare, which for Todd would be irrelevant because he's already past Medicare age, but the cost for them to get a plan before Medicare, before 65, would be about $1,000 per month. And after Medicare, we were still budgeting for another $5,000 per month out of pocket, which means after their Part B and Part D premiums. So those were expenses we were adding on in addition to the $8,500 per month. And on top of that, they had big travel goals. So they had been saving and they had been investing and they'd been really disciplined. They wanted to make sure they were able to fully enjoy some of the fruits of their labor. So he said, James, these amounts here, this $8,500 per month, we can live pretty comfortably on that. We can take some cool trips on that, but we want an extra $20,000 per year for the next 15 years to at least feel like we can do all sorts of things that maybe we haven't done in previous years. So we're adding on another travel amount above and beyond that. Now, in addition, we want to make sure that nothing like long-term care or any potential event like that derails their ability to spend some of this. So for each of them, we're taking the national average for in-home care and saying for the last couple of years of their life, there's an additional $60,000 per year for each of them just to make sure their portfolio can support that. Now, by the way, before we go on any further, you might be saying, what on earth does this have to do with our portfolio? Well, we're not starting with the portfolio. In fact, you should never start with the portfolio. You need to start with the foundation. What are your goals? What are we trying to accomplish? What other income sources do you have? Because then we can see how does this portfolio you have should not just be focused on owning good investments, although that's obviously very important. It's on owning the best possible investments that fit within your overall plan. So by starting with an understanding of their foundation, then that will flow into an understanding of how should their portfolio be allocated to best support this. The next thing we look at here is their income. So Todd's Social Security, he would collect when he retires of $3,400 per month. Katie would collect her Social Security. Her benefit would be lower. She had some years out of the workforce as she was raising the family. So her benefit is $825 per month, which really means she'd be collecting a spousal benefit once she reaches her full retirement age to get up to half of what Todd's benefit would be. So these are the basic facts we need to know that we can now understand what do their cash flows look like and how does that inform how their portfolio should be allocated. Now, by the way, if you haven't done so already, make sure that you subscribe to this channel. Every week we're releasing videos like this where we'll share different case studies, things we've actually done in our financial planning business to help clients so you can get an inside look as to what that looks like to see how that can be applied to you. So let's go to cash flows for Todd and Katie, which is what we always want to start with. So this cash flows page is what ties everything we just talked about together. What we see here is we can see year by year, starting from 2024 and beyond, what are all the various income flows? What are all the different expenses or goals or tax projections? And the net flows, what that's showing us is what is the portfolio's role in all of this. And this is really what's going to deliver what the portfolio allocation should look like. So let's start with income flows. What do we mean by that? Well, Todd and Katie are going to retire, which means their salary goes away. What other income sources will they have? Well, for them, it will be Social Security. And you can see year by year, what will Todd's Social Security benefit be? And how will that increase a little bit with inflation? What will Katie's benefit be if she waits until her full retirement age? Well, here's her retirement benefit. Here's her spousal benefit. One point of confusion is people say, well, you can't collect a spousal and your own. You're exactly right. But technically, your spousal is the difference between your own benefit and half of your spouse's. So this is her own benefit. This is the difference that Social Security would pay her to get to half of Todd's benefit. So here's their total Social Security benefit, and we can see that total amount in this column right here. If you go back to the summary, here's their total income flows. What we're comparing that to is their expenses. So their expenses look like this. Living expenses of $8,500 per month, that's their basic living expenses that we started with. We need to adjust that for inflation. So $8,500 per month is $102,000 per year. Apply an inflation factor to that to make sure that their cost of living keeps up with inflation. Then we look at housing. So on top of that, they're going to have a couple more years of mortgage payments. It's not going to be here forever, but we do need to factor in that payment for the next couple of years. Mortgage payment, interest payment, you can see that gets paid off in the first part of 2025. And so principal and interest payment goes to zero, but property taxes remains. So even though the mortgage is gone, they still have property taxes, they still have insurance, and those are the numbers we're looking at right here. So now we can see what's their total housing cost year by year and how's that going to change over retirement. Next, we look at healthcare. So here's healthcare costs for Katie pre-Medicare. Remember, we're planning for $1,000 per month for her benefit, and then that drops to $5,000 out of pocket after Medicare Part B and Part D. So here's what we're planning for healthcare costs, and then much later on in retirement, here's what we're planning for in terms of long-term care as well. So as we start going through that, here's their basic expenses, here's their goals. So remember, they want to take that travel, that vacation, $20,000 per year for the first 15 years, and then that drops to zero. And as we can see, what we're doing is every single year, we're going to say, what are your normal expenses, so your basic living expenses, plus your goals, so travel, plus an estimated tax payment. What is your total outflows, the total amount needed to support this lifestyle for you? Well, if we compare this total outflow, called $196,000, to their total inflows from Social Security of $40,800, what that means is $155,000 needs to come from their portfolio that first year of retirement. Now that number changes over time. Remember, their mortgage gets paid off, so the actual amount they need to take from their portfolio drops. Katie goes on to Medicare, so health costs drop. The tax amount is going to change based on what account are you taking money from. So what we do is we want to see how does this net flows number change, because this again is going to flow into how do you build a portfolio that supports this. The next thing we wanted to jump into for Todd and Katie wasn't just, okay, how much do you need to pull from your portfolio, but what account makes most sense to pull from? You have joint accounts, you have IRAs, you have Roth IRAs. Where should we be pulling money from to maximize the tax efficiency of what you're doing? So that's why we came to this page next. It's understanding what are you going to pull from. You have 401ks, IRAs, Roth IRAs, and what made most sense for them in their case, because they wanted to do some tax strategy involving Roth conversions, was to pull as much as possible from their taxable account in those first several years of retirement, which allowed them to keep their income lower and free up room to do some Roth conversions or other tax strategy. So I want to go back real quick, because what we see right here is it's going to make sense to pull money from the taxable account first. But if we go to their actual accounts, let's take a look at how they're actually invested. In their joint account here, they were fully in a Vanguard S&P 500 ETF. In Todd's 401k, they were fully in a Fidelity 2025 Freedom Fund. Now, by the way, this is not an endorsement of any of these funds. None of the funds I talk about in today's video should be construed as a recommendation. This is just what they were invested in. And by the way, I'm gonna actually give you a proposal of what some sample funds might look like that, in my opinion, could do a better job of addressing their needs more so than what they were currently invested in. In Katie's IRA, she also had the Vanguard S&P 500 fund. And in the Roth IRAs, they had the QQQ fund, the Invesco NASDAQ fund. So really owning big US tech companies. They had that in Todd's Roth IRA and in Katie's Roth IRA. So why does that matter? Why did I go back to this? Well, I did it for this reason. Look at their joint account. They have about $1 million there. That joint account is fully invested in the S&P 500. The S&P 500 is filled with wonderful companies, but keep this in mind. They're projected to need about $150,000 from that account the first year of retirement, and that number is going to fluctuate, but it's going to remain a pretty significant amount that they're having to take from that. Take a look at annual numbers from the S&P 500 here. This is just a chart that shows year by year performance change of the S&P 500. And you can see in some years, it's doing really well. But let's say, for example, they were to retire in the year 2000. What if you needed 15% per year from your joint account? So you have $1 million, you need 150, that's 15% that you're taking out, plus the market's down 10%. Then the next year it's down 13%. Then it's down 23%. It's not a good combination if you're also taking pretty significant amounts out of that portfolio. Or what if you retired in 1973? Well, 1973, you had a combination of inflation that was sky high, meaning your expenses weren't going up by 3% per year. They were going up in some cases by double-digit inflation rates per year. On top of that, the market dropped 17% in 73, dropped 30% in 74, recovered a couple years and then dropped double digits again. The point being, when you're looking at how you should be invested, it's not just enough to say, hey, these are wonderful investments. The S&P is filled with wonderful investments, but do those investments fit the objective of this particular account as it relates to your overall financial strategy? So with that in mind, I want to go back to this page here, their cash flow pages. What I want to know, what I like to focus on with clients is the first 5 years of retirement. How much are you projected to potentially need from your portfolio? Because what we need to ensure is that you can spend that money, whether the S&P 500 or any aspect of the market is up big, down big, or anywhere in between. It's not enough to have a financial plan that says, Todd, Katie, you can have a great retirement assuming the market is up double digits or more. It's not really an acceptable retirement or an acceptable outcome for anyone. What we really want to know is how much can I sustainably or safely spend regardless of what's actually happening in the stock market. So if we look at these first 5 years, there's about $600,000 that Todd and Katie might need from their portfolio to meet their income needs. Why am I looking at 5 years? Well, the average bear market in the S&P 500 takes about 2.5 years to recover. So from the time the market peaks to bottoms to reaches its peak again or breaks even again, on average, it's about 2.5 years. The longest time it's ever taken since the Great Depression is almost 6 years. So if you have 5 years of something set aside outside of the market, more conservative, more stable, then the combination of that plus dividends and interest that your portfolio will continue to generate even in the midst of a downturn, you're pretty well insured, not guaranteed, but pretty well assured that there's a good chance you can endure that downturn and have enough to see you through the bear market. So for Todd and Katie, the first thing I looked at is I said, you need about $600,000 in something outside of the market. Today, you're pretty much all S&P 500, NASDAQ, and then Todd had the retirement date fund in his portfolio. You need probably something closer to an 80-20 portfolio. Why 80-20? Well, if you need $600,000 and divide that by a portfolio value of $3.2-ish million, about 20% of it needs to be more stable, which means the remaining 80% of it can be invested for more growth. Let me show you what that actually looked like for Todd and for Katie. This is an actual proposal. Now, I'm going to show specific funds. These are not the actual funds that we recommended to them. I'm going to use Vanguard funds simply because Vanguard is very well known, and a lot of you are probably familiar with them. But I want to be very clear that this in no way represents a recommendation or an endorsement or any way me saying you should go own these funds. Absolutely not saying that. I just want to use real examples and apply them to the principles that we're showing here so you can see how this might work in practice. So here's a portfolio analysis that we did for Todd and Katie. And we started by saying, here is your current portfolio, Todd and Katie. You have your Fidelity Freedom 2025 fund. You have your Vanguard S&P 500 ETF. You have your Invesco QQQ Trust, so just owning NASDAQ and big tech companies. Here's the proposal that we put together. Again, not actually endorsing these funds. These aren't actually the funds that we recommended, but the allocation is very similar. What you can see here is we said you need more of a growth fund, a value fund, an international fund, a bond market fund, emerging markets fund, small cap, a short-term bond fund. When we did this, was it just to say, hey, let's throw a smattering of investments out there? No, not at all. There's very intentional reason for this. So for example, the Vanguard Short-Term Treasury Fund. This fund is extremely stable. It's not going to grow a whole heck of a lot over time, but it can provide some real stability and liquidity when needed. Now, why did we have $167,000 allocated to that specific fund? Well, because that's about how much they needed for 1 year of living expenses. So what does that mean? Well, if the market's doing really good in a year, then we probably don't need to touch this fund. We can probably live on our small cap fund or emerging markets fund or our US stock fund, whatever's doing really well. But let's say all those funds are down 20, 30, 40%. Well, we want to have something that can give us income for that first year of retirement. Then on top of that, we had a Vanguard Intermediate Term Treasury Fund with a similar allocation to it. So a little bit more aggressive. So on a scale of 1 to 10, we're starting to move a little bit up in that scale in terms of how much risk are we accepting, but it's still very much towards the conservative end. To say, look, if we've burned through the short-term funds and the markets are still bad, well, do we still have another investment that we can start to live on before we have to dive into our stock investments? Then we have a Vanguard Total Bond Market investment that's got $335,000 or so. And when we start to add this fund up with this fund and this fund, at least the amounts to all of them, you have 5 years of living expenses set aside on top of the dividends that are being paid from all these stock investments, even as the market's dropping. As I said before, these aren't the exact funds we actually recommended, so there's a little bit of differences between what we're actually showing here and what we actually did for Todd and Katie, but the principle remains here of each of these investments plays a very specific role in the portfolio and why we recommended it. The second piece is this. Today, you can see how much they have stocks, bonds, cash versus what we're recommending in terms of stocks, bonds, cash in the proposed portfolio. But this was the big difference, not just the amounts of stocks and bonds and cash, but today they were very concentrated in large US stocks. In fact, today over 80% of their portfolio was US stocks, and the majority of those were large cap stocks. This makes sense. They're mostly S&P 500 index fund and the Invesco NASDAQ fund. The only bit of diversification they really had was because Todd had a target date fund. And that target date fund did expose them to some more international or bonds or whatever the case might be, which is good, but it wasn't in an intentional way. It was just with whatever the target date fund said should happen based upon a target retirement date in 2025, not aligned to their specific plans. So what we put together was we said, how do you actually allocate this? Or how should you actually allocate to small, large value growth to make sure you always have something to draw from regardless of what the market's doing? And the next thing I want to go through here is these are the funds that we recommended, but Todd and Katie said, okay, great. Do we go do this in our Roth IRA and our IRA and our joint account? To which we said no. And to show you why, let's go back to your actual plan. If you recall, we were looking at where you're actually going to be taking money from in your portfolio first. Well, it's going to be your taxable account, your joint account. And if we need, call it $600,000 or so in your joint account, what we actually did was we said, look, you're not going to take any money from your IRAs or Roth IRAs for the first several years. In fact, we're going to be trying to move money from your IRA to your Roth IRA as part of our tax strategy. So if we're going to have $600,000 of your total portfolio in something more conservative, we don't want the conservative stuff in your long-term accounts that we're not going to touch for 10, 15, 20 years. We need that in the accounts that you are going to touch in the first several years to meet your income needs. So because of that, all of the $600,000 was put into the taxable account. So the taxable account looked more like a 40-60 allocation. 40% stocks, 60% more conservative investments, whereas the IRA and the Roth IRA, that was more aggressive in terms of the allocation. That was almost entirely stocks in their account, and their Roth IRAs were certainly entirely stocks. That won't be the case forever. Once required minimum distributions kick in, or once they start to draw down their IRA because of their planning strategy, well, we will want to shift some more of the bonds into the IRA as opposed to just the joint account, but that's why you continually monitor this, and you don't just have a set it and forget allocation for the entirety of your retirement. Now here's the last thing that I told Todd and Katie. If you look at what investment in their portfolio has performed the best over the past 10 years, easily, it's their NASDAQ fund, their QQQ fund that we saw in both of their Roth IRAs. And I said, look, since 2010, that fund has averaged over 14% per year annualized growth. That is an incredible rate of return. But then I asked them this. I said, do you know how that same fund, or let's not say that fund, but that asset class, so say the NASDAQ, has performed since 2000? They said no. I said, well, since 2000, the NASDAQ is up 5.3% per year, which is much less than over 14% per year, almost a third of the annualized return. Now I'm cherry picking because in 2000, the NASDAQ got wiped out, took a long time to recover, and then from 2010 until now, it's really done well. So I said, let's go way back. Let's go back to the implementation of the NASDAQ. In the first full year of the NASDAQ existing, which was 1972, since then it's up about 10% per year. If we compare that to the S&P 500, the S&P is up about 11% since that time. US small company stocks are up about 13% since that time. I only say that because they were right in their thinking of let's put the growth stuff in our Roth IRA. Where they are wrong in their thinking is there's a bit of a recency bias, and I see this all the time, of, oh, look, tech stocks. Tech stocks are the best growers. Tech stocks are the best performers. Look how well they've done over the past 10 years. It's absolutely right. But if we take a bigger picture perspective, how has the NASDAQ done over time? It's done quite well. I'm not going to deny that. But it hasn't done the best. So I gave a little pushback of we might want to own other types of assets in your Roth too. In fact, there are other asset classes that have demonstrated better long-term potential growth rates over that same time period. So let's make sure we're being smart about where do we own the conservative stuff, the growth stuff, and how do we make sure we're fully diversified, not just in our portfolio as a whole, but in each of the individual accounts tailored to the way in which we're going to withdraw them. So I hope this was helpful to see how do you actually determine a portfolio allocation based upon your investments, based upon your income sources, based upon what you're going to draw down first. One of the things we did next with Todd and Katie was we encouraged them to dream a little bit more. They had been so focused on saving and investing and living well beneath their means that by the time they got to retirement, what we saw was they could spend a whole lot more than they actually thought was possible. So if you want to see how we go through that type of an exercise to see what's actually possible, how do I dream to get the most out of retirement, the most out of my life as possible, be sure to check out this next video here. We walk you through an understanding of how can you tell what's possible to maximize your retirement without sacrificing potential future returns, without sacrificing potential running out of money in the future. That's what we go over in this video here. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.